Hello, my name is Matthew Copley, President and CEO of Copley Financial Group, and today we're going to do a market update on what is going on in the economy, the investment world. We're going to cover some really interesting economic data. We're also going to cover the new buffered index portfolios. We have some really good ones, so stay tuned for that. We're also going to take a look at some of the potential inflation data, what's happening with gold and silver, and so stay tuned. We got a lot to cover in this market update. First, let's cover the economic data, which all looks very good. Now, this economic data that I'm looking at, I'm referring to jobs. Unemployment data looks good. Unemployment rates are coming down. The number of people applying for unemployment benefits is way down. All of that data looks very positive. Also, when we look at the trade deficit, it looks absolutely fantastic. When we look at the trade deficit numbers, you're seeing a lot more exports going out of the United States, a lot fewer imports coming into the United States. This is a really big deal. We have not seen these kind of trade deficit shrinkage in a very long time. This is very positive. And so the third thing, of course, that everyone's talking about is inflation. The inflation data looks really good. It looks like inflation is coming down. At the same time, we have this good employment data. The one thing I want to caution you on is whether or not these numbers are accurate. One of the concerns that I have is the government has a history of putting out numbers that make themselves look good. It's kind of like if your kid goes to school, if they could put their own grades on their report card, what would they put down on their report card? All A's, right? And there's an incentive by politicians to make sure their report card looks good, especially when we have a midterm election coming up. So I think it's really important to understand that the data looks really good, but we want to dive in a little bit deeper on the data. For example, on unemployment data, we're not getting a lot of information on people that are not in this country legally because they are not going and applying for unemployment benefits the same way that U.S. citizens do. When we look at inflation data, when we dive into the numbers, there's a lot of baloney statistics that are put in here. For example, when they look at insurance data, like healthcare insurance, for example, they don't actually look at the cost of healthcare going up. They're looking at the profits of healthcare companies. What does that have to do with the cost of healthcare if insurance companies are making a bigger or smaller profit? They're using these adjustments in order to make the numbers look better. We know that healthcare costs are going way up. We know that insurance costs are going way up. And so when you look at these kind of manipulations, doesn't really reflect the real numbers. Also, when we look at raw materials, which is what I like to look at, how do we know whether there's inflation or not? Well, look at the prices. What are copper prices doing? Going straight up. What are aluminum prices doing? Aluminum's in all kinds of things. Obviously, the cars that we all drive, full of aluminum. Prices of aluminum's up 50%. This is a big number, right? What's happening to gold prices, silver prices? What's happening to, in fact, the only thing that's really not going up at this point is energy. Energy prices are down, but I think that's only temporary. I think that is a factor of a lot of new energy production coming online. More recently, in the last year, we've seen a lot of new energy coming online. And of course, is there going to be a lot of energy coming out of Venezuela? Are we going to be able to bring a lot of oil that was not available, or is it now going to come to the market because of what happened in Venezuela, which obviously is a big deal. I think it really changes a lot of the geopolitical landscape when you see what happened there, where you have a small number of U.S. soldiers go in and kidnap the leader of a country. I'm not going to go into the politics of this, whether this is a good thing or a bad thing or any of that. But this definitely is putting the rest of the world on notice. The U.S. clearly has really advanced technology. When you look at what happened with all these Russian missiles and anti-air defense that was supposed to be defending Venezuela. Venezuela spent all this money, massive amounts of money, to put in all this anti-air, anti-defense missiles. And the United States just walked in there like all that Russian equipment wasn't even there. And so pretty big change, I think, geopolitically, which obviously has an impact. I think this is helpful for the US dollar. I think it makes the United States look stronger on the world stage. But at the same time, you start looking at the prices of everything going up, And inflation, I think, is a lot worse than some of this data is showing. So there's a lot of positive in that economic data. There's a lot of things that we're seeing as far as unemployment looks good. The inflation numbers that are being reported look good. The trade deficit, which you can't manipulate, clearly looks good. Lots of exports, not as many imports, but at the same time, be very, very cautious. These numbers may or may not be entirely accurate. Speaking of Venezuela and all the news that's going on around the world, obviously Iran is a big one. There's a big political problem going on in Iran. Cities on fire, potential revolution. Obviously, the Iranian government in the past has been able to quell some of those uprisings in the past. Are they going to be able to do it this time, or is this different? I don't know. Don't let some of the potential with geopolitics affect your financial decisions as far as your investments. We simply don't know what the ultimate outcome is going to be from some of these events, like what's going on in Venezuela, what's going on in Iran, and elsewhere around the world, including the war in Ukraine, what ultimately transpires there. But the one thing that I do know is a very, very big deal, which is not getting as much news media attention, is the fact that Donald Trump sent subpoenas into the Federal Reserve for Jerome Powell. This is a major, major deal. Trump is basically signaling that he doesn't care about the Federal Reserve, he doesn't care about formalities, and he is going to bully them into doing what he wants. He wants lower interest rates. He wants to control the Federal Reserve. He knows that he's going to be able to replace Jerome Powell in the near future. But it's interesting. Jerome Powell could just go away, or he could actually step down and become one of the Federal Reserve governors, which he has the right to do, and he can stay on board, through 2028. So I think there's a little bit of a push by Trump to make sure Powell goes away. There is obviously, if someone is in that position, do they really want to take a lesser position? It's like someone who was president of the United States then becoming a congressman. Most people aren't going to step down into a lower position. I would think that Powell would want to step down. But maybe with all of the remarks that Trump has made about how he's a moron, he's stupid, he's not putting the interest rates down fast enough, too late, Powell, all these comments, maybe Jerome Powell just wants to stick around and put his finger in Trump's eye. And so by hanging around, and which would give, not another person that Trump could put on the Federal Reserve Board of Governors. So there's a lot of politics that are going on here. And this subpoena is really, I think, just a way for Trump to try to bully the Federal Reserve, to try to bully Powell. But what he is subpoenaing him about is a real thing. I mean, $2.5 billion for a renovation of the Federal Reserve building is absolutely ridiculous. And these numbers don't make any sense. I mean, you think about $2.5 billion to renovate a building. Let's start doing some math. When you start thinking about renovating your house, okay, let's say you've got $1 million house and you're going to do a massive renovation. I mean, new kitchens, new kitchen, new bathrooms, new remodeled flooring, the whole bit. You're going to spend $500,000, right? This is a lot of money. This is a big renovation on a house, right? $500,000. You could renovate 5,000 homes for $2.5 billion. Literally, 500,000 times 5,000 homes is $2.5 billion. It's the same amount of money. Do we really need to spend that much money? Where's all this money going? I mean, how much marble and gold and whatever else they're building, do we really need that? Well, at the end of the day, the Federal Reserve, the people there, they don't care. It's not their money. It's the taxpayers' money. Any money that they don't spend goes back to the Treasury. So why not? Let's just build the most ridiculous office building ever in Washington, D.C. That's what's going on. And clearly, someone needs to be looking at this. I don't think that it makes a lot of sense to spend that kind of money. But I believe that if Powell was doing exactly what Trump wanted him to do, he wouldn't care one bit about this $2.5 billion. Oh, spend $4 billion on the building. Trump would say, you're the greatest Federal Reserve chairman of all time, right? So the reason that he's going after him is because he's not doing what Trump wants. And so that's where you're seeing that come in place. And this is a big deal. When you start to see politicians push back against very, very powerful banking interests, it doesn't usually work out too well in history. Obviously, we can go back through, I'm an economic historian, I love to listen to this stuff, but there are a lot of very powerful people in our history, which you all know, that have been assassinated, that have had all kinds of bad things happen to them when they went up against very, very powerful financial interests. And that's exactly what Trump's doing doing by sending subpoenas to the Federal Reserve, he is really sending a message. And that message is do what I tell you to do. And you've seen him do this even with other Republicans that supported him. People like Marjorie Taylor Greene and that Thomas Massey, who are big MAGA type people. They didn't play ball with him, and he attacked them. Rand Paul, another one. He attacked Rand Paul, big conservative, libertarian Republican, and Trump went after him. So Trump will go after anyone, and I think he's sending that message, that he wants that message sent, that do what I tell you to do or I'm going to go after you. So this subpoena thing is a very, very big deal. I'm watching it very closely. It can definitely have a big impact on the financial markets, especially if the people in the financial markets think that the Federal Reserve and the president are kind of one and the same. And it has been, the Fed's always been political. They've always done what the administrations want, but there's been kind of this separation, where at least the illusion of a separation, but it looks like Trump just wants to bully the Federal Reserve and really push his will in there. And so that's something we're watching very closely, and I think that's a much, much bigger story than what's happening in Venezuela and Iran and other places in the world. And speaking of Trump, it's amazing how much energy this guy has and how much he wants to do, right? There's just one thing. Every day there seems to be a new thing that Trump's announcing, a new thing that he's trying to promote or push. And some of this stuff is absolutely ridiculous. When you look at credit card interest rates, talking about capping interest rates at 10%, it sounds good. Let's make sure that no one pays more than 10% interest on credit cards. This is a real economic problem. When you start to think about actually what would happen if you actually capped interest rates at 10%, it would really have a negative effect on the economy, a big time negative effect. I mean, Trump went after Kamala Harris when she talked about grocery stores gouging people during the election, that she wanted to set up all of the grocery stores where they could only make a certain amount of profit. It's a very small profit margin. It was ridiculous for her to say that. He rightfully went after her for claiming that grocery stores were gouging people. But what do you think that is going on with credit card interest rates? The same thing, right? He is saying that credit card companies are gouging people, that they should have a set amount of interest. It's no different than someone saying that the grocery stores are gouging people. When you start to think about credit cards and how they operate, it's very, very simple. And for everyone to understand how this works, there's probably about a 3% or so fee these credit card companies are collecting when people go charge stuff. So that's an automatic profit margin that credit card companies have built in. Then they also have the ability to have people charge stuff and then pay it back in the future. And obviously, if they hold it more than that 30 days, then there's interest charges. Well, you have to understand how credit card companies work. If you have a group of consumers that have a certain credit rating, certain income, and there is a 10% default rate, that means that 10% of the time they are going to go bankrupt, they're not going to make their payments, they're not going to pay back the money they use on credit cards. Those people are going to have a much higher interest rate than a group of credit card holders that have a 2% default rate, right? If a credit card consumers have 2% default and the company's making 3%, it doesn't matter. They can just charge no interest at all, and they're still making money, right? Because all of the merchants, all the businesses, they're covering the 3%. You got a 2% default rate. You still have a 1% profit, right? There doesn't have to be any interest. But when you have a 10% default rate, you have to cover that. That means that you have to charge at least 10% interest in order just to break even, right? And that's to make no profit. So when you start thinking about some of these people that are paying 15, 20, 25% in credit card interest rates, it's because they're in a part of a credit group where you have a much higher default rate. If you have a default rate of, say, 17%, well, then naturally all those people in that group have to pay 22% or 23% in interest on their credit cards. And so if you lower the rate to 10%, all that you're going to do is everyone who has credit cards above that rate, they're just going to get canceled. They're not going to have credit anymore. There's going to be no credit cards for anyone in that category. I mean, I don't pay 10% interest. A lot of our clients don't pay 10% interest because they have really, really good credit, and that's not going to affect them. Their credit cards won't be impacted at all. All these other people are just going to get canceled. However, it's going to cause all of the people with good credit to pay a lot more in interest. And here's why. If you cap it at 10%, the current people that are paying 22 and 25%, they're going to go down to 10%. Now those credit card companies are going to take a loss now on the existing one. Now, people aren't going to be able to take out new credit. They're going to cancel their credit cards. But some of those people are not going to pay, and they don't have a new credit card. There's going to be a bunch of defaults. And then what happens? Well, the credit card companies have to make it up somewhere, so they're going to charge a higher interest rate to the people that can pay. So this is just financial suicide. It's really an economically dumb thing to do, to cut interest rates down to 10%. They're talking about doing it temporarily, maybe for 1 year. Obviously, this potentially could be beneficial to allow people to get their credit under control. It gives them a year at lower rates to try to pay stuff back and get it under control. But at the expense of what? A bunch of credit card companies losing a bunch of profits and then gouging their other customers for the money. So this makes no sense. The other thing that Trump announced is $200 billion that Fannie Mae and Freddie Mac are supposedly going to buy all these mortgages out in the marketplace and drive down interest rates. Well, this is absolutely ridiculous. Just taking money to buy mortgages is what got us into this problem to begin with. You have all this quantitative easing, right? This is what the Federal Reserve was doing, was printing up a bunch of money and buying mortgages, driving interest rates to super low. And what happens? This does not help people buying homes. All this does is cause home prices to go up, because now people can qualify for more credit so they can buy more house with the same amount of money. This is a disaster. What we need, if you really want to help people buy homes, if homes are unaffordable, we need more homes. That's it. You need to put plans in place. You need to have incentives for home builders. The government needs to go in to encourage home builders, cut the red tape, allow these home builders to go in and actually build a lot more homes and get rid of a lot of the red tape that prevents them. Get rid of these outrageous permit costs and everything else that goes into home building. We need more homes. It's supply and demand. If you want to allow people to buy homes and they're unaffordable, you need more homes. You don't just lower interest rates, because all you're going to do is have the same amount of people chasing the same number of homes, and now they have a lower interest rate, so they're just going to bid up the prices. It's the exact same thing. It does not help at all. So the main thing that we need to understand is the government needs to get out of the way. Whenever the government gets involved in something, it becomes more expensive and the quality goes down. It's just like anything else that the government is involved in. The more the government gets involved, the more that things cost, the more the quality disappears. Get out of the way. Let these companies build more homes. We do not need Fannie Mae and Freddie Mac to come in with $200 billion. We don't need to cap credit card interest rates. Just like we don't need the government to go in and regulate grocery stores and how much they're charging. It's no different. So Trump talks like he's this big conservative. He's the kind of person that is going to protect us from all the socialists and this socialist in New York that they just elected. But in reality, capping interest rates at 10% and buying $200 billion worth of mortgages, that is as socialist as it gets. Now, what is the result of all of this craziness, of all of this Venezuela and Iran and Jerome Powell subpoenas, and every day Trump comes up with a new thing that he's doing? The result of this is inflation. You are going to see prices going up, and we're seeing that. Look at gold. Record price today was $4,600 the last time I looked. Silver prices, $87 an ounce on silver. I mean, these are just astronomical numbers. You're seeing those prices go way, way up. In addition to copper, aluminum, platinum, all of these things are going up. Even, there was a lot of action that was taken by the current administration on beef prices, and beef prices did drop quite a bit. You see this there was a deal put together with Brazil, beef prices came down, and all of a sudden they're rallying back up, and we're almost back to where we were before they put all this stuff in place. We're only about 6% off of where those beef prices were. So everything's going up, from beef to aluminum, to copper, to gold, to silver. So it's very important to understand that you need to own assets. And that's why in our Copley Tactical Fund, we are focused heavily on assets. By the way, up more than 33% last year in returns for 2025. We're super proud of our performance there. A lot of that has to do with the fact that we're focused on those inflation hedges. Now, some of you may have noticed we made some adjustments. We rebalanced that a little bit, changed up what we're doing. We think there's some real good opportunities in small and mid-cap stocks. We think there's some real good opportunities in energy, which I think is really important. But we also want to adjust some of the gold and silver investments. We made a lot of gains, and we were focused primarily in that tactical fund in large cap international gold mining companies that they'd done so well, up over 100% for the year, phenomenal. That really drove a lot of the performance within the fund. And so what we did there is that position, which had grown from about a 10% position up to about a 13% position, we actually took that position back down to the 10% that we started 2025 with. So we kept that same position. And then I was thinking we need to invest this in other areas, rebalance what we have. But I went back to the drawing board, I did the math, and I said, we should buy more gold. How do we buy more gold? I mean, the valuation with the gold prices going up and the current gold mining stocks that are out there, I mean, they're trading at super low valuations. If you look at what these companies are making in profit, and now that energy prices are down, oil prices are down, I mean, the profits on these things, when they start reporting in February, I have a feeling you're going to see these gold mining companies do very, very well. So knowing that, we wanted to adjust this up a little bit. So we took a 5% stake in junior mining companies that are more focused in the United States and Canada, which is an area that I think is really overlooked. People aren't looking at this. These are smaller companies. These are the kind of companies that are going to be acquired by the bigger companies. They have a real good opportunity of growing, and you're not seeing a lot of the gains that you've seen in the large caps in that small cap space. So we took a position in Copley Tactical in that. We're focused also on energy, which is a good one. Energy is a big deal. There's so much coming with the data centers, the AI. I mean, you look at a Gemini search takes 17 times more power than a Google search. We need the power. There's just not enough power to handle all the AI. Where's that power going to come from? And so energy is really important. And right now, oil's cheap, energy is cheap. These companies are producing lots of good profits at current $60 barrel oil. They're making good profits. And so it's a good investment right now. A lot of those energy companies, the prices come down. So that's a focus. We're looking at energy. We want to get more of our clients exposed to the energy space. If oil prices and natural gas prices go up from here, and they've been down. So if they go up from here, we're going to see some really good results. If they just stay where they're at, we got good valuations, good dividend yields. So I think it really, really works. So we're taking a look at that, and but keep an eye on gold and silver prices. I think it's important, and energy too. I mean, what do you think? Put down in the comments below. Write down what you think is going to happen with gold and silver prices. What you think is going to happen with energy? Am I crazy? Does this seem like it makes sense? I mean, I'm looking at the numbers, and it looks to me like the mining companies are undervalued. The energy companies are undervalued. Tell us what you think. One video I did previously, if you didn't get a chance to catch it, I think is really important, is understanding that the stock market can be up and down at the same time. And how can the stock market, for example, can the stock market be up 10% and down 10% at the same time? And the answer is yes, it can. Here's what happens. Let's say the stock market is up 10%. Oh, everything's great. The stock market's up 10%. But if the value of the US dollar has dropped 20%, versus commodities, versus groceries and gasoline and airline tickets and everything else, if the purchasing power of the US dollar has dropped 20%, at the same time that the stock market's up 10%, we're actually down 10%, because you have to look at what everything is denominated in. So when people say, oh, I think the stock market's going to crash, well, the stock market can crash and still go up. And this is one of the things that I think is very important for everyone to understand, is we can go through bad economic situation and still have the stock market go up. And it's because of inflation. It's because of the dollar. You're seeing now gold is now a larger holding among central banks all over the world. They own more gold than they do US Treasuries. This has not happened for a very, very, very long time, and this is a concern. A lot of countries are not trusting the US dollar the same as they did before. They're looking at putting money into gold. I don't think this is slowing down anytime soon. So you really need to have your money in assets, and it doesn't matter whether it's gold. It can be in high quality value stocks, consumer staples, companies that make food, energy. All of this is really good, but you gotta own assets. It's very, very important to own assets, because the people that are gonna get ahead in this kind of environment are people that own things that just go up in value with inflation. If you're struggling, if you don't own assets, the only way you make more money is if you go to your employer and get a raise. Well, unfortunately, if that raise is going to be less than what it's going to cost you and everything that you're buying, you're not getting ahead. You're staying right where you're at. So you need to own assets. We're going to help you do that. And that's why we're focused on all the investments we have. We're focused on high quality value, real dividends, real cash flow, real companies that make a real profit. Now let's talk about one of our favorite investments that's done tremendous for our clients. We love it, the buffered index portfolios. We actually have 4 new products available. I want to go over all 4 of them with you. All 4 are great options for the right person. The first one's kind of our standard 2-year S&P 500 index. It has an 18.3% cap. This means if the stock market goes up over the next 2 years, anywhere from 0 to 18.3, you get the whole thing. Market's up 10%, you're up 10. If it's up 15, you're up 15. If the market's up 25%, you're only going to be up 18.3. That's our cap. With that product, we have 2 insurance policies. If the stock market starts going down, we actually make money on the way down. The inverse return down to -20. So if the market's down 10%, not only do you not lose, you make 10%. If the market's down 19%, not only do you not lose, you make 19%. All the way down to -20. It does have a 20% maximum reimbursement. So if the market was down 25%, you'd get reimbursed 20, you'd still be down 5%. Great product. We like that buffered index portfolio. It makes a lot of sense. We have a couple other options though that we've negotiated that I think are really, really good that we should be taking a look at. One in particular is one that we call the lesser of index. And so this one, they look at the S&P 500 and the Dow Jones. The Dow Jones is kind of the safer big cap companies. S&P 500 is more the broader market, S&P 500 companies. And the way this one works is you get the lesser of the two up to 27%. So if in the event one's up 22%, one's up 18%, you're going to be up 18%. If one's up 30%, one's up 24%, you're going to be up 24%, up to 27%. So that gives you a little bit better cap than 18.3. Also has a fantastic insurance policy of 30%. Also the lesser of, if the stock market drops, you get a 30% reimbursement, but this one is not dual directional. You do not get the inverse. That means if the market's down 10%, you don't make 10%, you just get your money back. Okay, all the way down to -30. So this gives you some protection, does not give that inverse feature, but obviously 30% insurance versus 20 and a 27% cap versus 18.3. So it just gives you an opportunity to potentially make more money, does not have that inverse feature. The third one, which we like a lot, is an uncapped, and this one's really nice. It actually is the lesser of the S&P or the Dow. Uncapped, you get whichever one is less. So if one's up 25% and one's up 15%, you're up 15. If one's up 30%, one's up 27%, you're up 27. It's an uncapped, you just get the lesser of. And this one comes with a 15% insurance policy that is dual directional. So if the market's down, if it's down 10%, you make 10. If it's down 12, you make 12. So you get the inverse return on the lesser of. This is actually a pretty good product. Normally, I'm not a big fan of these. I like to stick to the single indexes, but the numbers on this look very, very good. And an uncapped on the way up on the lesser of gives you a lot of potential upside. Now, finally, the fourth one, which we're super excited about, we still have the 5-year leverage performance. It's at 186% right now. So in the event that you go in for 5 years, you can make up to 1.86 times whatever the S&P does. If the stock market's up 50%, you're going to be up 90%. If the stock market's up 100%, you're going to be up 186%. Fantastic performance. And so this gives people that have kind of a longer term vision, they want to be in the markets for 5 years or more, gives them an opportunity to beat the S&P 500. It's a fantastic product. We like it a lot. All of these products, all 4 options that are available, do have a deadline of February the 3rd for funding. This means the funds have to be in, which means if you're transferring the money from somewhere else, whether it's coming from a bank account or from another investment account, it has to be into Schwab and in time to fund it by February the 3rd. So be careful of that. I don't know how long we're going to have these kind of numbers. It's just particularly a really, really good month for buffered indexes. We got great pricing, so good time to take advantage. Thankfully, we've got a lot of clients that are actually have a lot of accounts renewing this month, so we'll be repositioning those for those people. And for those of you that are interested in maybe other funds that you have outside of our Charles Schwab network, then give us a call. We're happy to help you. We're happy to advise you. But now is really good timing on some of these buffered index portfolios. Finally, we have our guaranteed interest, and a lot of people are interested in this right now. Obviously, with current valuations in the market and some of the volatility and things that are going on in the world, they say, I just want to know what I can get guaranteed, can't lose, insured. Well, we have the 3-year multi-year guarantee annuity. We've mentioned this before. You know what it is. It's like a CD on steroids with an insurance company. Great product, tax-deferred interest, 5.5%. So a 3-year at 5.5%. The 5 years at 5.8%, so nice returns. Again, 3-year at 5.5%, 5-year at 5.8%. We have 2 new additions that you should seriously take a look at, and people might think, well, why would I want to do this? We have a 7-year also at 5.8% and a 10-year also at 5.8%. Now, why would someone lock in their money and get the same interest rate? I mean, if you can get 5.8% for 5 years, why would you lock it in for 7 years or 10 years? And it's because you get that 5.8% the entire time. This is really important. What if interest rates are down in the future? What if the Trump gets his way and he gets the Fed to push rates down, or they do a lot more quantitative easing, or they come in and buy some of these different mortgage-backed securities or U.S. Treasuries and they drive rates lower? Well, in the future, if interest rates are 3.5%, that person that locked in that 5.8 is going to keep getting that for the entire term. So it is a potential option for people that have kind of, I want guaranteed payments, I want guaranteed interest, and it's nothing to sneeze at. 5.8% is a really good return. So again, 5.5 on a 3-year, 5.8% on 5, 7, or 10 years. And so that is a great interest rate, guaranteed. And what you see is what you get. There's no commissions or loads or fees that are going to reduce that interest rate. That is after, that's net. That's what you get after the fact. So pretty darn good rate. So I hope that was a good market update. If you want more information, or reach out to us, ask for one of our financial advisors here in the office. They'll be happy to help you with all of the things we discussed in this video. I hope you got a lot out of this, and I hope to see you in our office very, very soon.